I'd like to talk to you now about the meaning of internal controls. I'm going to read to you a definition of internal controls that I found in a textbook that was published in the late 1980s. But it is without a doubt, I believe, the best definition I've ever read. And there's one or two terms in it that are a little bit dated, like laboratory studies, but that's okay. But let me read it to you. I'm going to read it to you twice. Second time with a little emphasis. The meaning of internal control. When considering internal control, an organization's objectives include safeguarding assets and providing reliable financial information. But internal control extends beyond the accounting and financial functions. Its scope is company-wide and touches on all activities of the organization. Internal control includes the methods by which top management delegates authority and assigns responsibility for such functions as selling, purchasing, accounting, and production. Internal control also includes procedures for preparing, verifying, and distributing to various levels of management current reports and analyses that enable executives to maintain control over the variety of activities and functions that constitute a corporate enterprise. The use of budgetary techniques, production standards, inspection laboratories, time and motion studies, and employee training programs often involve engineers and others who are far removed from the accounting and financial activities. Yet all of these devices are part of the mechanism referred to as the internal control structure. Okay. So let me highlight a few of those points again. When considering internal control, an organization's objectives, not the auditor's objectives, here they're talking about the organization's objectives, include safeguarding assets and providing financial information. You'll notice also that it talks about how top management delegates authority and assigns responsibilities for selling, purchasing, and production. It includes the processes and procedures for verifying and distributing to various levels of management current reports and analyses that enable executives to maintain control over all functions of a corporate enterprise. So it's not just accounting controls, and a lot of times accountants tend to think when they talk about internal controls, they tend to think of what here are called accounting controls, but it's far beyond that. Now, auditors test internal controls. The auditor's goal in testing internal controls is different from management's goals. The auditor's goal is trying to figure out where the company's internal controls might not be as strong as you would like them to be, and therefore you have to extend and do more audit procedures in those areas. So the auditor's looking at their evaluation of internal controls to decide how much work they must do and in what depth. Also, when one is doing fraud, you, as the auditor, and you're looking for fraud, then your expectations will be more stringent and more tight. And if you're using statistical sampling to evaluate internal controls, your desired confidence levels will be higher and your tolerable rates of error will be smaller. Now, management, on the other hand, so the auditor's looking at it, saying how deep and how far and where must I expand audit procedures. Management, on the other hand, is in that first sentence that I just read to you. When considering internal control, an organization's objectives, not mine the auditors, but the organization's objectives, include safeguarding assets, we don't want waste or theft, and providing reliable financial information. Because if you're the management and you're getting reports based on data and the controls to generate those reports are not strong, you're going to be making decisions based on faulty information, and it's more likely that your decisions will be incorrect. So that's management's goal or interest. Now I'll give you a couple examples outside of what most of us would call accounting controls. I was once the controller of a company that manufactured mattresses and box springs. And as most of us know, box springs and mattresses, you can buy king size, queen size, full size, as they call it, and you can buy twin size. Now, when I was the controller, I knew I was also the credit manager, and I would see and approve the orders that came in. And if I saw a lot of orders coming in for twin size bedding, I knew that a month or two from now, the company's financial statements and income statements weren't going to look as good. And that is because the cost of making a twin size mattress or box spring, as you go from the increment of cost, as you go from twin to king size, those increments in cost are disproportionate to the increases in the selling price. And selling prices are set in the market. So king size is proportionately much more profitable than a twin. So if you're manufacturing and selling mattresses and you're getting a lot of order for twin size, the profits aren't going to be as good. So if you're trying to control the profitability and you're part of management, you want to be aware of that. Another example, we had a client that very profitable company. It made a lot of money. The owner made a lot of money. And they had several locations throughout Pennsylvania, and they had a really good accounting department. And the accounting department did separate financial statements for each location, very detailed. And one day the owner came to me and he said, "Chuck," he said, "I get these financial statements and they're good." He said, "I get individuals for each location and I get consolidated." He said, "But when I'm trying to analyze them, he said, it's so much and so much data that I get lost in it." He said, "Can you help me?" And I said, "Yes." And I told him this. I said, if you look at any company's income statements, there's almost never are there more than 4 numbers on the income statement that are really vital to management. One, of course, is sales. Beyond that, 3 or 4 significant costs that tell them something about the nature of the cost, tells them something about how things are going. So what I did for that man is I made a graph for him, bar graph with columns. And the first column was solid blue, and it showed you year-to-date sales. So he could look at this graph and look at these blue columns and see how sales were moving as the year went by. Then he identified 3 costs for me. So the second column, right beside the blue one each time, had 3 different colors in it. And each color represented one of those 3 expenses that he identified. So by looking at these the column for the second bar of the cost, he could see, obviously, the height of the bar told him something about the total cost. And as he looked at the colors changing one relative to the other, he could see if there were any anomalies. So by looking at a graph, no words, dollar signs here, years or months here, he could see how revenues were moving and whether that made sense. He could see how the total of these 3 costs were moving relative to revenues, and he could see how these 3 costs were moving one relative to the other. And if he identified an anomaly, then he could go back and look at the detail. So that's what they're talking about here. Reports by which management can control the activities. Now, a third example, early in my career, I was working for an international CPA firm in Philadelphia. And it turned out that in the early 1970s, the Philadelphia Federal Reserve Bank, one of the 12 branches of the Federal Reserve Bank, was being robbed by a group of its employees. They were literally walking out the door every day with their pockets full of $100 bills. And it turned out there were 22 people in collusion, including 2 internal auditors. My point here is that no matter how good your internal controls are, if you have 22 people operating in collusion, they're going to get around those controls. Now, the safety feature is this. When you have that many people in collusion, sooner or later somebody's going to mess up. And what happened in this case, one of the people, everybody was spending their money, redepositing it. One guy was storing his in the trunk of his car. So he got to a point where he had about $350,000 of $100 bills in the trunk of his car. He got nervous about it. One night in the middle of the night, he drove up into Northeast Philadelphia and he threw it all down the storm drain. A couple weeks later, they had a whole week of pretty heavy rains. It was clogged. The street was flooding. So they called the street department, or whoever you call, and they come out with these long metal rods to unclog this sewer drain. Then gases and stuff started bubbling up, and all of a sudden, $100 bills started bubbling up. And they thought that was strange. Now, the part that I thought was really strange, the people actually called the police. And what they noticed was that these $100 bills, they were in very, very bad shape. Even though they'd been in the water, they were in bad shape. And they noticed that all these bills had been released through the same branch of the Federal Reserve Bank, not Philly, but the same branch. So the police actually called the FBI, and the FBI went down to the Philadelphia Fed to see what they thought. And when it was down there at the Philadelphia Fed, they said this money would have been unfit for circulation. Each reserve bank has a currency destruction unit. They started to ask the people in their destruction unit, and people started to confess. So when you have that many people in collusion, they can get around the controls, but sooner or later it's going to fall apart. So that goes back to this definition. Internal controls is a lot more than accounting controls. They're tools by which top management uses to control their enterprise. And it's not just the accounting controls. So remember that when you're looking at internal controls. Thank you.